My name is Heather Maria Kubik. I'm the Assistant Business Manager here at HR Logistics, and I'll be facilitating the webinar today. So if you have any questions or thoughts as we go through the topic today on HR economics, please feel free to enter that into the chat box or into the question and answer, and keep this as interactive as possible. Now, for a brief introduction for those of you joining us for the first time, Christy Evans is the CEO Thought Leader here at HR Logistics, and as an HR practitioner turned entrepreneur, she provides a unique insight on how HR can strategically support business needs. And over the 8 years that HR Logistics has been in business, she has developed the discipline Human Risk Management, which is the integration of human capital initiatives with finance and technology to support business goals. Now with that, I'd like to turn it over to Christy.
Thanks, Heather. Hi, everybody. It's really nice to have people attending our HRL lunch break, and the great thing about it is that we record it, so just in case something interferes, you can always come back later and listen to it again, or if you're unable to attend, you can grab it later. So this is a terrific opportunity for us to take a quick 30-minute session and think about how human resources, human capital management, and human risk management can actually come together and create value for the organization. So the first thing we're going to look at is we're going to look at some key components that will have impact on our discussion. For example, what is your CEO thinking? I mean, I think it's important for us as practitioners, and I was a practitioner, so I used to be on that side of the desk. I think it's important to think about what is the perspective of your CEO in your organization, or the person who is the steward of the ship. How are they considering the path forward, and what are they thinking about when they're looking at the economics, and how do they think about the organization? We'll also look at key economic indicators, because some of what I think it's important to understand is just sort of a framework for how you consider the news that you get and the information that comes at you. And there's an awful lot of information that comes at us these days with the recession and the concern that we all have about how our economy is going. We're also going to look really quickly at a couple of current events that are going on that are just very recent, and we'll talk about how those businesses have managed their HR structure and their culture and what it looks like for them as a business in this economic environment, because it helps you sort of get a feel for the application of human risk management and how that application in a business environment impacts the capabilities of the business. Then I'm just going to make some prediction on what I think the future looks like, because you really get an awful lot of information out there. You get a lot of conflicting information, in fact. I mean, we are all human beings. We all have different opinions, and it's out there in every sector, in every discipline. You'll have some that think that there is no double-dip recession coming, and others that think there is. And so you always have more than one opinion to pull from, and it's probably a combination of everything. And then I think that there's a real change coming towards us about the future workforce. So we'll take a quick look at what I think the future workforce is going to look like. In thinking about what your CEO is thinking, to me it's really one question in that mind that really kind of captures everything. It's how do we increase profitability for the organization? And it's not just a question of how do you make more money, because a business, in order to survive, has to be able to make a living. Just like you and I have to make a living, so we can buy groceries, and we can make our car payment, and we can make our house payment, and we can send our kids to school, and all of those kinds of things. A business has things it needs to do in order to sustain itself over time, and in order to remain in business, paying employees and paying for services and creating a portion of value within our economy. So when we talk about how do we increase profitability, we're talking about the capability to be healthy as a business over the long term. And there are many different ways to consider how to go about this. There are different methodologies that can be used. For example, they might go after something like increasing their market share. When you think about this kind of thing, it's really like, how do we get more of the business that's out there? For example, when AT&T went out and pinned the deal that they had with the Apple iPhone, they had an exclusive right to sell the Apple iPhone for many months. I don't remember if it was 12 or 24 months, but they had that market cornered. And when the iPhone hit, they increased their market share because they were the only ones who had it, and you had to go to AT&T to get it. So that was a great move on their part to increase their market share, and that increased the profitability of their company. Now, I'm sure they knew they would not be able to have that, and they had it in the agreement. Apple would not have signed an agreement that said, you know, forever you have the market cornered. But that gave them a jump on the competition. The other thing that is a recent example of how a company might go after increasing its market share is the recent acquisition that Google made of Motorola. One of the divisions of Motorola, Google went out and bought it for so many billions of dollars in cash. And what they primarily bought it for, based on the news, is for the patents that were part of that division. Then that says to me that Google is positioning itself so that they will own the patents as they move forward with the Android phone, and that they will have the ability to really start going head-to-head with iPhone and really competing in that marketplace with very strong technology. So they're, again, using this opportunity to go out where they have a lot of cash, and there's opportunity out there, even in this recessionary market, to go out and reposition themselves to gain market share. So again, they're looking at ways to increase their profitability. Another way a company might go after increasing their profitability would be to increase their profit margin, which is the difference between how much it takes to produce this service or this product, how much does it cost, and how much am I charging for it? What's my price? So one of the things that they might think about doing is, if the product is a very popular product and it has good sales right now and it's surviving in this recessionary market, they might be thinking about increasing that price. If consumers are really still interested in that product, then consumers may pay a little bit higher price for it, which would increase their profitability. Pricing is always sort of that area where you're trying to make sure you don't price it too low, because then you're not going to have enough profit margin, enough money to actually move and do the things that you need to do in order to improve the business and make it stronger and increase your market share or do any of these other things. But you also don't want to price it so high that nobody's interested in it, that it's just, you know, seems to be unreasonable. You need to price it to value. So they may be looking at a pricing strategy when they're looking at that profit margin. A lot of businesses have been looking at the reduction of cost of goods sold, and that is basically, it's the reduction or reducing the amount of money that it takes to produce the product. So how much does it cost me to create a widget? You know, if I'm selling widgets, how much does it cost me? And then how much do I charge for it? So if I can reduce, if I'm selling it for $10 and it's costing me $8 to produce it, then $2 is my profit margin. What if I could produce that same widget with the same quality for $7? Well, I've just increased my profit margin to $3. So a lot of companies are looking at how can I improve my manufacturing process, how can I go to a different supplier of goods. Maybe there's somebody that has some, you know, equally good quality but maybe is not as high a brand, somebody that has a that is a new kid on the block that might be worth trying because they have a good value. All of these kinds of things might be things that your CEO is thinking about. How can we improve our capabilities so that we're not spending so much money on producing what we sell? How can we reduce that cost? And that gives us more profitability as well. We're also hearing a lot about reduction of overhead. We're seeing reduction of overhead in the decrease of employees and the layoffs. We're seeing the reduction of overhead in the company's way that they're driving things on a lean and a mean kind of process. They're trying to keep that overhead down. They're looking at ways of reduce that. Also improve again, the profitability of the company. So if I'm looking at different ways to meet that need, then I'm looking at all of these different things and what makes the most sense for me as an organization. What is the most, what has the greatest possibility of success? What has the least risk attached to it? What can I do that has more predictability? But you also have, okay, maybe this has less risk, but maybe it also has a lower rate of return. So maybe I do this and I don't get quite the bang for the buck that I'd like to get. So there's this balancing act. And there's always the possibility of creating new products. For example, in the Google buy of the Motorola division, they may have new products on their horizon that they'd really like to purchase or they really like to build, but they're concerned about patent infringement, and that could be a costly situation, and it's just, it could be very disadvantageous because if you get into litigation and all that stuff, so they may be thinking, well, it'd be easier just to go outside and go ahead and buy it. And then we have protection that we can really fully produce this new product. But creating a new product is really a pay-it-forward proposition. So in this economic environment, paying it forward could be a good idea because you've got interest rates are low. A lot of businesses have cash on hand. So it might be something, but you have, it's a risk. Excuse me just a sec. Pardon me, sorry. Now let's take another look at some of the economic indicators that are out there that your CEO might be paying attention to. Your CEO may be getting some of this information from the conference board, which is one of the resources. And I noticed as I was doing some research on different things that they actually have something that's called CEO confidence. And overall, basically, from quarter end 1 of 2011 to quarter end 2 of 2011, CEO confidence is down from 67 to 55, which means that 67% of the, I'm sorry, excuse me just a second. 67% of the CEOs that responded had a reduction or thought of it more positively last quarter than they did this quarter. Now it's down to 55%. And CEOs' assessment of improvement of current economic conditions is actually down from 85 to 33. That is a huge drop. And they're not thinking, obviously, that things in current economic conditions are improving. Their optimism about short-term outlook is also declining from 66 to 43. And Lynn Franco of the conference board actually says their confidence has cooled considerably in the second quarter as a reflection of the sluggish U.S. economy. So they expect economic growth to continue at a very slow pace, and you're going to see that in their reluctance to move forward with certain types of projects, to move forward with hiring. You may continue to see CEOs looking at things from a position of, well, we don't really know what the economy is going to do, so we're going to sort of stay in this holding pattern. What we do see in the CEO thinking, though, based on the conference board information, is that they do see market demand as a principal driver of profits. And we had just talked about some of those things that your CEO might be thinking, some of those ways that that CEO might be looking at how they can impact profitability of the organization. And 70% of CEOs expect increases, especially in durable goods. And durable goods equates to things like manufactured goods like airplanes, cars, things that are concrete manufactured goods. So they're expecting those types of durable goods to actually increase. And even as of an article, I believe, that came out yesterday, they actually have gone up just a little bit. There is a higher a rise rather on the demand for autos and airplanes and those types of products. So far we are seeing that correlate with what the survey from the CEOs with the conference board said. And interestingly enough, if we look at how they expect these profits to rise, 57% are thinking about market demand and growth. 20% cite the cost reductions, and we just talked about the different ways that you can impact profitability of an organization. So they talked about the cost reductions that they think that they can continue to look for. They then also talked about price increases. We talked about that as being another strategy to where they could increase profitability of the organization. And then others cite new technology as a key driver. And I think technology is really being seen as pervasive in many different ways, because I'm also seeing this, and since HRL does a lot of work with technology, I'm seeing this as part of one of the stronger sectors. And when you look at the labor statistics, they actually do talk about professional services and technology as being an area where there are an increase of jobs rather than a decrease. In talking about what key economic indicators actually are, I think it's important to remember that this is not the kind of thing that you immediately learn overnight, and that there are a lot of different things out there, a lot of different statistics and different ways you can look at technical data to try and build a picture. A couple of sources that are key sources that are used on a regular basis are the National Bureau of Economic Research, which is actually a private firm that's used for business cycle information, and then the Bureau of Labor Statistics is sort of like a principal fact-finding agency for the U.S. government, and is used for a lot of labor economics and statistics. And so these are organizations that have been around for a long time, and they collect a lot of this data and put it into report formats and put it into percentages and put it into a numerical indicator that sort of gives you a composite of what all of the data together is telling you. Because there's data from too many different sources to be able to look at all of them individually. You may have 100 different reports of different things, and so these organizations put together these composite numbers to help economics, or other economists rather, and other business leaders, and to help the the stock market and all sorts of people that look at economic indicators have a feel for what's going on out there in the market. And I think it's important for us to talk about what is the difference between, I think the two most interesting are leading and lagging. There are some others, but they don't seem to have as much press release out there. They're not the ones that are talked about as much. And we'll talk a little bit about what B2C and B2B is. When you look at a leading KEI, you're really looking at an indicator that is considered a short-term predictor. It is something that is evident before the economy reacts in a way that everybody sees it. So, for example, one of those things is the stock market return. If the stock market returns are going down, then the economy is starting to slow down. And if you break that down into its pieces, then what you're really looking at is its earnings per share. So if earnings from a business, a public business, are going down, then that business is not making as much money, and you're starting to see an indication that the business out there on the street is actually going down. That they're not getting as much business. Another thing is building permits. If building permits go down, it's a leading indicator of the economy slowing down, because people are not getting permits to build new things as often or as frequently. Money supply, which is information that comes through the financial institutions and tells them about how much currency is in the market and how much money is in the bank. And if the money supply is going down again, things are contracting. So, and then you also have something that is considered a leading indicator that's called an index of consumer expectations. And what's interesting about this is that it's really telling you what consumer confidence is and whether or not consumers are thinking things are going to get better or worse. And since consumers do make up a good portion of our economy, it is all about the things that we buy, the groceries and the toilet paper and all those regular things that we buy on a regular basis are a lot of what economic trading back and forth is about. If they're thinking that things are going to get worse, then they're probably not going to be spending much money. They're going to spend it only on what the must-haves are. So that's an interesting indicator as well. These are all, actually the Conference Board creates something that's called a leading economic index that is a composite of 10 of these, including those 4 that we just talked about. Now, thinking about lagging indicators, I wanted to bring this one into our attention because this is really important, I think, in that one of the lagging indicators is the unemployment rate. When we look at the unemployment rate all the time, and as HR people, we also look at how that rate's impacting or think about how that rate is impacting us on a regular basis. Indicator of the unemployment rate, that is actually 2 to 3 quarters behind, I'm sorry, somebody's at my front door, I don't know why, 2 or 3 quarters behind the actual state. Really, it's not an indicator of what's happening today. It's not an indicator of what's happening right now. It's an indicator that actually is looking backwards. So you can't look at it as a today indicator. A B2C business, you'll hear this term a lot, and a B2C business is actually a business-to-consumer business. So it's a business B2C business that is actually selling services or goods to consumers. So you're looking at something like grocery store. I sell food to consumers. B2B is a business to business. So I sell, for example, HRL sells services to other businesses. So most of the time we're in some type of transaction with a B2B. And that's important because what we're finding that is really having a dramatic impact on our economy is the B2C sector, because consumers are not buying as much. Now we're going to take a quick look at current events, and I know we're starting to get a little bit short on time, so I'm going to try and move pretty quickly through this. But a couple of the big stories that have been out there is Groupon has been talking about going into their IPO and really trying to, and I can't remember if they've actually gone through the IPO or not, but they're really trying to get out there and do a lot of venture capital work. And the interesting thing is they've gone from 37 employees in 2009 to 9,625 employees in 2011. So they've hired 9,600 employees in 2 years. The crazy thing about this, and it sounds amazing, they've expanded globally. 4,800 people are in sales. And but the other issue that's part of the Groupon case study is that they're also losing money, like $100 million either a month or a quarter, I can't remember which. And so when you look at this, this is a B2C business. This is a business that is selling to consumers, and the consumer sector is weak. So if they're in the business to sell coupons to consumers, and consumers are not in the mood to buy, then what they've done is they've created a business model that's very top-heavy. And it's going to be difficult, I think, for them to succeed moving forward because they're building infrastructure. And infrastructure has to have enough customers to sustain it, but they're losing money. But then you look on the other side, and you've got the Apple news that came out this morning where Steve Jobs has decided to step down as CEO. But over the years, they have built a relationship with their customers that is so passionate and so built on value that they may very easily be able to sustain the damage to him moving into something different, because it's really important for these people to continue to have cutting-edge technology. They have built all this trust in their consumers. They have this terrific relationship with them, and now you're seeing how they're moving forward with changes in the organization that are necessary. So in these two business case studies, when you think about the human risk management application of it, Apple built their relationship with their customers first and gradually built their infrastructure. Groupon is moving forward with an aggressive style to build infrastructure first, and they haven't established that trust with their customers yet. So the question here is, you've got two examples of business to consumer or B2C businesses. The question in human risk management has to be, can Groupon survive when they've created such a top-heavy organization and they don't have the sales to sustain it? Have they hired and built out too fast? So what's the future look like? I think B2C businesses will continue to struggle. I think that they will continue to have to operate very leanly. I think they'll continue to have low profit margins because the consumers are it's going to take time. Consumers are actually paying down their debt, which is, they're saying that consumers are making better payments and paying down more of their debt now than in the last 10 or 15 years. And that is actually the smart thing for them to be able to do. The problem with that is that because consumers are contracting and not spending information or spending money on what they're doing, the interesting thing is that it is having an impact on our economy, because they do make up a portion of that economy. They make up a good, strong portion of it. And so that contraction in their spending habits is impacting those B2C businesses in a way, and it's going to remain, I think, to create struggles for them. B2B businesses, however, we've heard about $2.5 trillion, $3 trillion out there on the books, and the B2B businesses are continuing to spend money, but they're not going to spend money on employees. They have, working in their favor, sort of a perfect storm. They have had the opportunity and had to actually operate more leanly because of the recession, so they've had to cut back and become much more lean and much more efficient. They can use contractors to get things done without making a long-term commitment to employees. They've got strong profits coming in because they've they've cut back in ways that have been practical and have really created a stronger, better business. And they've made changes to delivery and infrastructure, and they also have the ability to position themselves for the future because they've got all that money in the till. So I think that you're going to see B2B businesses continue to be pretty strong, but I think the problem that they're going to run into is that they're going to outlive some of this goodwill. So let's take a look at what the future workforce is going to look like. My prediction is that the recession that is global, I really believe that the recession is global. It's everywhere. It's all over Europe. It's, we're seeing it everywhere. And I think it's going to change the way the workforce looks like in the future. I think we're having a convergence of various things that are happening out there that are changing the way we will work in the future for maybe forever, because these things, while they were all things that were happening already, they were happening at a much slower pace. And so because they were happening at a slower pace, they weren't forcing change. But now with the recession, they're actually forcing change. And part of that, of course, is technology. We've all heard so much about technology and how it's empowering and how it's enabling people to work in so many different ways. Excuse me. But we're also seeing there's a decrease in trust in businesses and in leadership and in government, and that's going to have an impact on how employees look at their relationships with people who employ them. And they may not want to be an employee anymore because they may not trust that relationship anymore. They may not want to be anything but a contractor. They may want to have more flexibility in their lives so that they can work differently. And also I think it's going to drive businesses to become more flexible because they have the capability to reduce cost by increasing flexibility, by letting people work remotely, by letting them have a little bit more empowerment to work in different ways. They're going to find that there are ways to reduce cost, and that's going to drive some of that flexibility as well. So I think we're going to be looking at a new business structure that's going to be composed of a lot of things like increases in part-time workers. I think you're going to see an increase in contractors, and we're already seeing this, but it seems to be driven by the economy because businesses are not hiring full-time employees. So there's a whole lot of part-time workers that when you look on the Bureau of Labor Statistics, for example, they see a high increase of part-time workers. So it's interesting to see whether or not that will actually decrease, because it may be that it's a very effective way to get the work done, and it may be that people find there's greater work-life balance in having more control. But I think that this will also increase the demand for portable individual benefits that are not necessarily group benefits, because people will start to take potentially more control over how their lives are structured and what kind of benefits they have, and they'll become more like the free agent nation that we've been hearing about for several years now. I think this recessionary outlook is going to push that. An increase in flexible and remote schedules, they'll be able to have more work-life balance, and it saves the company money. So I think that, again, the companies that have held on to the brick-and-mortar structure are going to push into this and have more, are going to be more receptive to creating more flexible and remote schedules because they can see the ROI on it. If you can figure out a way, and this of course impacts HR and the hiring and the structure and all of that, if you create a way where you pay based on production or based on some structure where you can see statistically and through metrics how a person is performing, since you don't have the capability to see them face to face, then there will be the ability and there will be more reception to that because it's going to be a cost saving. So the last thing that I'd bring up is that businesses who are in the buyer's seat right now because of the perfect storm, I do believe the tide is going to turn and they're going to be struggling for talent in the future if they don't embrace the new workforce paradigm. So as an HR person who's out there and you're looking at what's driving the way the business is doing business right now, what's driving the structure, then one of the things you have to think about is how am I going to retain that talent when the B2C businesses start to come back? Because even when someone moves now, most businesses are in the same boat. Everybody's running pretty lean. So even if I were in a B2B business and I were going to jump ship and move over to another business, I probably can't get a job at a B2C business because they don't have the demand to pull me in, but I can get a job at a B2B, but it's going to be another business that's running very leanly. So I'm not going to be much more happier there than I'm going to be at the business I'm in now. So that's going to be part of the challenge as things start to change in the economy. So I think I'm running a little bit late. Sorry for the interruptions and the hiccups, but I think we're almost done.
Great, thank you, Christy. Just one quick question before we close down. This is what kind of suggestion would you give to someone to get started? And how would you begin this process? Somebody may be overwhelmed a little bit with, it's a lot to take in. So what would you recommend?
I would recommend that you just start absorbing what you can and exposing yourself to information. It is a new language. It is just like learning Spanish or math or anything else. It's a new language. It's a new way of communication. There's acronyms rather that you have to get used to what they mean. You have to get used to the familiarity. There's the way of talking that as you watch some of the economic shows and stuff like that, you'll see that the way they talk about the economy is slightly different. So it's just continue to expose yourself. That's what I had to do for myself as a business person. I wanted to start to understand what this stuff is and how it worked, and in the beginning it was over my head and I just couldn't quite grasp exactly what they were telling me. But now that I've been paying attention for a while, and I mean a while, it took probably a couple of years before I really started to get comfortable with it and really started to feel like I knew it, but that was based on the amount of exposure I was able to give myself. So just jump in and don't expect yourself to be able to understand. There are still things that some of the show hosts and the economists say that go right over my head, and I'm thinking I have no idea what that meant. But I'm not supposed to be the expert here. I just want to be informed.
Great, thank you. Well, I'm going to have to stop us here. Thank you all so much for joining us today, and if you'd like to continue this conversation, we will put a written blog on our website so we can continue the conversation. Also, after we close today, you will be asked to complete a short survey of the webinar, so please take a few minutes to fill it out, as your feedback will help us continue to provide value through these webinars. Now, our next lunch break is in 2 weeks on September 8th, and we will be talking about project management best practices for HR projects. So if you'd like to register, please feel free to visit our website, hrlogistics.us. That's www.hrlogistics.us, and go to the calendar page. And then feel free to invite your colleagues if you think they might be interested as well. And for those of you who are new today, if you'd like to receive our monthly newsletter, please let me know and I can add you to our email list. So feel free to send me an email. That's heather@hrlogistics.us, or visit our website. Thank you all very much for attending, and hope you have a great rest of the week, and we'll see you next time.